Wall Street cat is in the house. In this short final video devoted to value investing, we will finish up the series with me showing you how to use screeners to generate value and growth ideas. So what is actually a screener? As we already know, investment ideas come in all shapes and forms. They could hit you on the head when you are in the mall shopping, while eating out on holidays, or while doing your job in the workplace. As I have already described in one of the articles I wrote on Peter Lynch at our website www.wallstreetcat.com, that is how I actually clashed with the idea of online dating, Tinder and its parent company Match Group, which at the time of recording this video has actually just become a five-bagger, meaning that had you invested in it 3 years ago, you would have made about 5 times your money. However, sometimes you are out of ideas, and that is when screeners kick in. So let's quickly go to FINVIZ.com. That is actually the website which screener service I use most of the time. And fun fact, the name is actually derived from the words of finance and visualization. So then just click on screener. Oh, and there you go. Now you can search for a company that is based on your own personalized criteria. So basically on the criteria that you yourself set. And if you watch the previous couple of videos, you will be aware of the ratios that I now just set up in here. So let's look for something that is simultaneously cheap and that might be considered a growth stock. So let's put in a PE, so that is a price to earnings ratio below 15, a forward price to earnings of below 20, and TPS for the next 5 years that grows at about 20%. Also EPS for the next 5 years, which is again at 20%, and maybe sales growth that is past for the past 5 years, that is again 20%. And there you go, that is something that is cheap and that grows at a decent pace. Also let's put in a price to earnings to growth ratio that is under 3, which basically means that the growth of the company sort of outpaces its value. And finally you can put in the country you're interested in, or maybe you just want to look for cheap companies, and I mean not from an investment perspective but from a purely mathematical one. And also maybe you want your company to be able to cover up its debt obligations. So therefore we put in a current ratio that is above 1. And there you go. By the way, the companies we're generating are the ones which we would want to buy, because we might very well generate such companies that we wish to short. However, that is way more complex, so we will leave it for a different time. And we're all done. We find this Turkish telecommunications service company I have never heard of, but which is probably their main telecom, and which is both undervalued and grows at a decent pace. Moreover, it is the only company that satisfies the criteria that we have set. It is important to note that screeners are just a means to discover new companies or to check whether companies we know satisfy our criteria. Once we discover this Turkish telecom, this does not necessarily mean that we should be already prepared to invest all our money in it. This is just the starting point of our analysis. Then we ought to read the annual reports of the company, and if you ask me, decide whether to trust this company's annual reports. If you're not interested in the companies that the screener has to suggest, my recommendation is to simply skip them and wait for better days. Don't research something you're not really interested in and move forward. Of course, it is ultimately up to you to decide. That's all I have on screeners. Now you can search for an idea, discover a company, and perform both quantitative and qualitative fundamental analysis. If you still don't know how to do the last couple of steps, well, check out our 2 previous videos. That's all for me for today. Like, dislike, well, couldn't care less, subscribe and like our Instagram and Facebook pages. Also check out our website www.wallstreetcat.com. Peace out!